Welcome everybody to an hopefully timely edition of our video webinar series. This one's War, Politics, and Your Money. There's a lot of headlines going up with the U.S. and Israel and the price of oil. We're hoping this will be informative and to show what's going on in the markets and where the opportunities we're seeing. Um, with us today, we want to with Michael Debrina, Diego Fabero, and myself, Ryan Hunter. Hopefully, we're going to go through and shed some light on what's happening in the markets. What are the markets thinking? How are they reacting? And what, more importantly, how we see things evolving and what the opportunities are going to come from it. So, with that, I'll kick it off into we'll dive right into it. I think obviously for those who've been following the news or filling up their car at the pumps, this is the biggest 1 month move in the oil price since 1990. And as of this morning, we're on track for the biggest 1 month move in oil price ever. So obviously a pretty significant, shock with, the U.S., Israel targeting, multiple sites across Iran, and with the Strait of Hormuz, the biggest oil choke point in the world, accounting for around 20 to 25% of not only oil, but LNG and natural gas as well, flowing through that narrow corridor. So obvious to say this had a huge impact on the markets. And, across all different types of markets, the bond market, equity market, commodities. And there really has been, nothing has been spared from one of the biggest moves that we've ever seen.
Yeah, and one of our fears with that is oil's hovering around 100. That could get up to 110, 115, and so this next slide just talks about the impact of oil on inflation, which is significant, and it's one of the underlying fears that we have, and we're monitoring fairly closely. So this slide just outlines what the market is projecting as far as inflation or the potential for inflation on a move forward basis here.
Yeah. So obviously with the price of oil, impacting all sorts of the price of almost everything really, whether it's shipping or the actual production of, goods, uh, inflation expectations are moving up. And with that, not only inflation expectations are moving up, but the potential impact, like Diego said, on, if we get oil in the 110, $120 range, that starts to have an impact on the growth as well, as it's, a lot of stuff becomes uneconomical with oil at those prices. So a few different things that the market's fearing, not only the inflation, but sort of the growth side as well.
Yeah. And I think that affects the interest rates as well. So, I mean, in the US, they were expecting rate cuts in 2026, and that's been priced out of the marketplace at this point. Which is not favorable for equity markets at the same time. So, a lot of impact.
Yeah, but despite all that, I mean, we've had, again, with going back to that biggest move in 1 month period, almost in history. Um, the market and the oil markets are still predicting that this will be over relatively quickly. Um, the futures market and the futures curve, is basically saying short term there's a big supply crunch, but over the long term they're expecting oil to come back into a normal sort of range. And once you know what we've talked about is this could all be over very quickly, or it could escalate fairly quickly. And there's a lot of noise out there, but right now the oil and commodity markets believe this will be relatively short lived, and there will be a quick resolution to all these conflicts, and the gas and oil will start flowing through a pretty narrow choke point once again.
Good.
However, I mean, the markets, you know, pricing in potential for a ceasefire. These are prediction markets, and with basically live odds on what people see these events being. So market sees a decent chance that there'll be a ceasefire or some sort of truce by the middle of summer or the start of summer on June 30th. But there's also a good chance that with the 82nd Airborne and 3,500 U.S. troops moving into the area, that there could be U.S. troops on the ground at some point this year. So that, again, coming back to there could be a very quick resolution to this, or this could escalate fairly quickly. And I think that's sort of the messaging that's come through from the White House is that there's been a lot of noise. We were talking earlier, like, is the U.S. is saying they're negotiating, Iran saying we haven't heard from them. There's a lot of noise out there, and it's hard to know what's truly going on. I think that's had a big impact as well.
Yeah. Sorry,
Go ahead.
Go ahead.
So I think that's what you see. You're seeing one step forward, one step back. You see markets like today. Today's being Monday, March the 30th. Markets are green. Some negative news comes out saying that Iran's not talking to the U.S. to try to resolve this issue. Markets tend to take a step back. So it's been a little bit of a foggy, unclear of what's really going on in throughout this whole war. Go ahead, you.
Yeah, one of the challenges is the conflicting information that we're reading and seeing, and it's really difficult to wage what direction these talks are going. And to echo Mike's point, we're getting positive and we're getting negative, and we're not really sure what is accurate. And so that's creating some of the biggest challenges just from a portfolio management and market and economic perspective. So
And we've talked to a number of people. They're all in the same boat. I mean, it is a little bit confusing of really what's transpiring out there. So there's mixed messages. I mean, the other day I watched Fox News and they said the war is over. CNN is saying that the U.S. is losing the war. So I mean, it's confusing. Our focus as we go through this presentation is really about high quality companies, and we'll re-echo that later on in the presentation.
Yeah, for speaking of quality companies and sort of the markets and how they've reacted, you know, where we've been overweight has been the U.S. and the U.S. markets, and those have fared relatively better compared to a lot of the international. Um, Not only is the tech side of the market not as cyclical as some of the other sectors, which is the S&P is pretty heavy in. Um, the U.S. is a net exporter of oil, and it's not. It's a very different story than 20 years ago when in the Iraq War or other Middle East conflicts where the U.S. was highly dependent on oil. They're fairly insulated from this from a strictly energy perspective. So the U.S. with its tech heavy weight and its relative insulation from the big moves in the oil market, that's been a relative winner. So all things, obviously, there's still been some red in the markets, and everyone's feeling the pain. The U.S. market has been relatively stronger than the others, Canadian and international markets, and Europe as well is very dependent on the flow of oil through the Strait of Hormuz and Asia as well. So that's been a positive sign that the U.S. market's been a bit stronger. On that sort of note, with the U.S. market, especially compared to Canada, gold and silver, you would typically think of being a hedge against this sort of geopolitical activity has been not a good hedge at all so far. You're seeing, gold go from 55,000 or 5,500 an ounce to, almost 4,500 an ounce, and the price of silver moving down, even further, almost 40%. So, people who have moved to gold or silver very heavily in the past few years have definitely, felt the pain of, a lot of this geopolitical noise so far.
I think this might echo as well that this may be short-lived. I mean, normally you'd see gold spike up, continue to grow. And I mean, I've talked to a number of clients saying, we should be buying gold and, it's 9,000 and so forth. But it's going in the opposite direction. So, I mean, it's signaling the same as the poly markets that we showed earlier, that there's more likely that this will be resolved over the next couple of months.
Yeah, I think
if not.
Yeah, I think that, and not only that, I think people are, quite honestly, if I had to throw my opinion, was taking profits, any profits they might have made, and looking to buy better companies and better bargains at actual companies out there, as opposed to staying in gold. I think they're looking for, high quality companies that have gone on sale and selling off their gold to do so. And I think even the U.S. dollar, looking at the Canadian U.S. dollar, since the start of the strike, the U.S. dollar is quite strengthened quite a bit to sort of the highs that we saw earlier this year. So that's a sign that people are moving into U.S. assets, U.S. dollar assets, not only with interest rates coming up, but they view that as a safe haven.
So there's a greater level of comfort with the USD and US investments. And so we have seen a shift from the European as well as the Asian markets moving into USD and USD investments. So it's a critical event that's occurring and historically has happened during times of uneasiness. So 2%, 2 cent move, it's pretty significant over a short period of time.
And especially when you consider, typically, you know, Canada benefits with the when oil prices are up. You're seeing that, yeah, again, the market's sort of looking past that and, moving into more US dollar assets. It's kind of not following the oil price as closely as it usually does. With all that to say, I think you look at the way the market sold off. We've been 5 weeks down in a row. I think we're at areas, and I think Mike and Diego would agree that we're at a high level of fear, a high level of uncertainty in the market that almost echoes kind of where we were almost 12 months ago. And I think, this is representing a pretty good buying opportunity. I think, especially like Mike said, we'll talk about some high quality companies, at a discount. I think this represents a pretty good buying opportunity, and the market's pricing in a lot of fear right now.
Yeah, I like to say that it's actually the markets are more afraid today than they were last year in April. And it's funny, I was more afraid back in April last year than I am now. But for some reason, there seems to be extreme. I think the problem is because we use the word war. Last time we had tariff issues in April of last year. And because of the war, people think it's a lot worse than I think it actually is from a market perspective. And so it creates opportunity. And it will show you some slides from last year, because last year what we did in April, if you recall, is we did we were buyers of the marketplace. And we were the beneficiaries of all those purchases as well. So go ahead, Diego.
Yeah, just typically when you have extreme fear like we have right now, those are the buying opportunities. And we've seen over the first 12 weeks only 3 up weeks, which is unusual. Market typically wins 60 to 62% of the time. So it is, well, we may not be at the bottom. There's certainly great buying opportunities with some great companies that, as Mike had said earlier, that we're going to take advantage of. So a little saying that Ryan had put up here by Warren Buffett, be fearful when others are greedy. Be greedy only when others are fearful. So something that want to make sure that people are taking advantage of and certainly utilizing. And what we've got here is the volatility index, and while it is spiked and is hovering in around that 30, historically when it's jumped over that 30 level, it's really created some great buying opportunities, and that's what we're looking at right now.
Yeah, if you go back to when you saw that last spike of the VIX last year, and the market was even, you know, more fearful, you look at where we're at tracking relative to that. So we've already, felt a good amount of pain in the market. But if you look at where the sort of path went, we're already through a lot of this drawdown. And like Diego said, we might not be at the bottom, and nobody, the expression is nobody rings the bell at the bottom to tell you when it is. But the forward returns after these sales are these sell-offs are typically very strong. Like if you look at where things ended on the NASDAQ last year compared to where we were at this time, I think it's significant. And that's why we're excited to get some of these deals and take advantage of it.
Yeah, again, re-echo, this is a buying opportunity, not a selling opportunity. And so, we'll talk more about the quality of the companies and all that, because that's going to be key in the portfolio as we move forward. But let's continue on, Ryan.
Yeah, I think this is something that we talked about, and part of our learnings from even last April is that there is a Trump put in the market. One of our thesis to start the year, as we went into this year, was that this is a U.S. midterm election year. And clients of ours, have heard us talk about this before, because these are typically quite volatile years. But we know most administrations, U.S. administrations, are sensitive to what the market's doing going into their election. And our belief is that, the Trump administration is particularly, sensitive to the markets and what they're doing. So we believe that on some level there is a de-escalation, sort of built in that, if things get too bad, the U.S. administration is going to do whatever they can do to keep the market, moving in the right direction. Go ahead, Diego.
Yeah, just, right now, the Republicans control the House and the Senate. They're in jeopardy of potentially losing the House. And so, yeah, like Ryan said, our thesis is that the current administration is going to do what they can to continue to control that. And so there is things that they're going to be trying to do to ensure that, one, oil prices are, have come down, markets have improved, and that the general public is in a good position. And so, that's going to be really important over the next few months that he has taken care of that.
And I think if I could say that, that's why I think the war needs to get resolved sooner than later. The longer this takes, oil price stays higher, the probability of a rate cut goes down, and the wealth effect gets affected as well. And whenever you have these midterm elections, I mean, people vote and look at, do they feel richer or wealthier today than they did prior? And if the answer is no, they will vote the opposite direction. So I honestly believe that resolution on this war will probably happen sometime in the month of April. Time is crucial for Trump if he really wants to win both the House and the Senate, and he's got to get things back on track. So time is not his friend right now.
Yeah, absolutely. And again, we've mentioned these midterm election years before, and we've seen the volatility. This is a pattern that is, fairly typical throughout the markets. There are drops during the year, and the years still end up positive. And on a forward basis, on a 12 months forward, your returns, even though you have significant volatility throughout the year, your 1 year forward returns are almost always positive, despite even some much more significant dips than we've experienced so far. So, on average, you're 16% down and you're still almost positive 36, on a 12-month forward basis. That's why we're excited to put, money to work and lean into this sell off more than anything.
So I'm just taking two more seconds on the slide. So this slide is showing you that the average drawdown, I think what Ryan was saying, is about 16%. So you can see in the midterm election year, it's always red. It's 100% probability you're going to get a draw in a midterm election year. The extreme is, somewhere between 4 or 5%, and I think I saw 35% or so a decline. But if you look at the end of the year, there's a 64%, just under 64% probability that we end up in the green. And you can see the returns are quite significant for the year. And if you look 12 months forward, it's 100% probability you'll be in the green. So, I mean, if you look at probabilities in the markets, you got to play them in that direction as well. So we do believe that, by the end of the year, we're probably going to be in the green again. And if you look 12 months down the road, we'll be in a better position than we are today as well. So we see this as an opportunity. We don't get scared about the drawdowns. We actually get very excited about it. I think that's where you build wealth.
Yeah, absolutely. And not even if you go outside midterm years, I think Mike said it perfectly earlier when he said, this isn't the time to be a seller. This is the time to be a buyer. You look at you, and you can go back and all the way to the 70s, and there's been some extremely significant events that have had some drawdowns similar to this. But I think staying invested, and throughout this time, and even being a buyer, has always served you over the long term. Next week is anybody's guess, but we just know that over the long term, these are going to be the opportunities that really you know help you reach your goals, help you achieve better returns. You can pick any one of these numbers here. You look at it on the sort of the chart now, how scary COVID felt at the time, and now it looks like a blip in the chart. And I think, again, if you look in a year, 12 months, 18 months from now, you're gonna be seeing the same thing. That is just another event on the chart.
Yeah, I think these two slides complement each other in that this second one gives you more of a visual and really identifies a number of crises and events that have occurred over the last 50 or so years. And the market has been able to continue to move forward. And so it's important that we try and deliver that messaging that these are buying opportunities, and certainly we're not fearful as we enter into some of the crises that this administration has led us into.
Yeah, even just to echo again on the midterm years, you've seen, U.S. midterm years, comparing the performance in the first sort of 60 days of the year and what the performance is, on a go forward basis. So again, you know, from that drawdown to the year end and the full calendar year, you're seeing this sort of pattern where in the past, it has been a positive. It has been positive for the markets, despite, even a bad drawdown at the start of the year, the market recovered, and even the calendar year ended up being in the green. So I think this just echoes again what Mike said, that, we still believe that this year is going to be green. The probabilities, are leading us there. I think that's where we're going to end up for the next year. And not only that, you're seeing, this was as of last Thursday, institutions aren't really cutting their forecast for the year yet. You're seeing them, maintain that they still believe this will be a positive year. So 7,600 was, Goldman's forecast. They reiterated that, last Thursday, kind of a show of confidence that they still believe that there will be a resolution to this, and it'll be, again, over fairly quickly. I think also, again, to echo, being a buyer, not being a seller, trying too much to time the market, you know, it's something that, you'll probably seen before, but these returns, your return can be significantly diminished, especially over the long term, if you miss some of the best days in the market. And, the best days in the market are actually usually almost followed by from some of the worst days in the market. So once you felt the pain, and selling off can have a major impact on your long-term returns. So again, being a buyer, not being a seller, and, not missing those best days in the market that are usually the rebound from some of these sell-offs, I think is absolutely critical.
I think that's key. Yeah, 'cause I know a lot of people are thinking, should we get out of the marketplace? But I love the slide. If you're fully invested, you're up 11%. If you look and you miss the top 20 best days in the year, you're down to 6.2. You miss the top 40 days of the year, you're down to 3.2%. So, I mean, at the end of the day, we want to be smart with respect to what we're doing in the portfolio and being tactical. But same day, you want to also be allocated properly, because especially with the Trump effect that we talked about earlier, all you need is Trump to send out a quick tweet or whatever and talking about this is over, resolution has been complete, whatever he's going to say will drive the markets up rather quickly. We don't want to chase this as well. So again, I want to reemphasize, we want to look at great quality companies that we think are starting to get undervalued right now, and have an opportunity for us to buy them at a significant discount. So
Yeah, I agree. Like, this could all be over so quickly. And we learned that last April is all it takes is a few days and a few tweets. And if you were out of the market at that point, you did not recover very fast from that sort of drawdown. It took you much longer to get through that than if you had just stayed the course and, even again, been a buyer. So I'll touch on just quickly, some of the opportunities that we're seeing in the sell-off. I think from our discussions as a committee, software has been a major area where we've seen a lot of interest in buying in. A lot of software names have been sold off significantly. They think that, AI is going to replace a lot of these software things, and why build a program and spend the time when I can just get, ChatGPT or Claude to make it for me. So a lot of these companies have seen, really, sharp declines in their price. But, we believe the good software companies that can use AI are going to come out of this even better, and much more improved. And they're going to be able to use these tools to offer a better product. And if anything, they're going to come through this in a much more positive way than the market believes right now. Especially just to highlight CrowdStrike. I know this is, one that we bought in a crisis a few years ago. Um, and if anything, with the more and more technology, there's going to be much more demand for cybersecurity, significantly more. It's a very important area of the market as all these AI tools become more powerful, and companies, you know, the data what they have is their golden ticket. So we think CrowdStrike is for an example is a great buy at these levels.
You want to talk about financials too, Ryan, or?
Yeah, sure. I'll go through finance. I mean, again, this is a sector that's been, hurt with, rates rising rapidly. Some concern on, is the price of oil gonna like dampen growth? Um, but if you think about a name like Goldman Sachs, is that one that we like. Um, there is a huge M&A and IPO pipeline in the market right now. So for the big diversified investment banks, there's a lot of deregulation coming, but if you think about all the IPOs that like SpaceX that are in the pipeline, I think these are, this is a great time to be adding some of the big diversified banks that have a wealth management, a trading, capital markets and investment banking. This is a great time to be adding. We see especially if REITs cool off, we think these banks are a great buy at these levels. And power and energy as well. Not only we've seen this oil shock, and you've seen AI, adoption continue to accelerate even, the need for data centers and to power these data centers. The US's grid in particular is very old, needs a lot of capital spending to get better. And a company like GE Vernova making huge turbines to power natural gas plants is an obvious beneficiary, and all the servicing and that requires that comes throughout the grid through Quanta. So those I think are three themes that have probably been hit the most in this sort of sell off, and even before that we think are now really good opportunities sort of across the board.
And I have to echo that. I also believe that power energy is going to be a theme over the next 5 and 10 years. I mean, just there's going to be huge demand with AI, and the opportunity here is not a 1 year opportunity. This is going to be a long-term one. And so you want to be involved in the sector as much as you can. I mean, GE Vernova has been a great win for us. And I mean, if any pullback, we would buy that in a heartbeat.
Yeah, absolutely. Power, I think, again, these oil shocks sort of remind people that, energy and energy security, is extremely important. And, if those companies or countries that aren't energy independent or don't have, access to energy or efficient means of producing power, these kind of shocks impact them even more. So I think the investment in these sorts of companies is going to be massive over the next 5 years.
Yeah, and indirectly, it's an AI play. It's not just what you mentioned, but I mean, AI is a big part of all this. So I mean, the demand's going to be significant over the next little while.
Yeah, like on the AI theme, I think that's obviously the data center construction is just incredible in the U.S. and the money being spent there. But I mean, these are companies, Microsoft down 20-25% year to date, despite, what I think Mike was trying to say, and, and I will echo, is that a lot of the fundamentals of these companies are just getting better and better throughout every quarter that they report. Microsoft had 78 billion in cloud revenue. That's almost 20% growth from this time last year. And they've doubled the amount of long-term contracts they've signed for cloud services. And this is a stock that's been, one of the worst performers in the market so far year to date. So we think this is a tremendous opportunity to buy into Microsoft. Apple as well. They've been, you know, sort of, discounted by the market in that they're not an obvious AI play. But I think when you just look at 2.5 billion devices out there active, they have the opportunity to, when they do implement an AI strategy, and I think they have started to, I think they're one of the obvious sort of winners in that space. Whether it's upgrading Siri or allowing, other AI assistants onto their devices, they have the platform to do, you know, they have the platform to be a tremendous leader in the AI for, personal computing or personal devices across all the board. And, iPhones are still doing $83 billion a quarter, which is the highest ever iPhone revenue. So that's significant. That's a name that we've liked quite a bit. Mike, I know you're still flying the flag of Nvidia significantly. I know that's one of your favorites, and one that you have a tremendous amount of belief in.
Yeah, I just think at the price where it's at right now, again, I looked at earlier this morning, it's around 169. I think somewhere between 160 and 169, that's a great buying opportunity. I think this thing is heavily discounted. Just, you talk about the cash flow, last quarter revenue is 68 billion. I mean, that's significant. The positive cash flow that it has is unbelievable. The demand is still very strong going into 2027. So I think that I actually think this stock should be at 220, 225 where it is right now. So I think it's severely discounted. I think it has a long way to go. At some point, I mean, when we start seeing CapEx starting to slow down, I'll be a little concerned, but I don't see that right now. The amount of money these mega cap companies are spending in this area is so significant. I mean, the pipeline, I mean, they've got a pipeline out to 2027. That's fantastic. So I love the stock. I think anything below where it is right now, 168, 169 is a great buying opportunity. And if you got a year or two down the road, you'll be a big beneficiary of that company in itself. So
No, it's amazing, the Microsofts, what they're spending to upgrade their cloud, and you train these AI models. It's only Nvidia. Companies have tried to come in and provide a bit of competition, but for the cutting edge, there's just no one that's doing anything even remotely close to what they are. And just to highlight again, I know I mentioned it in the sort of the previous slide, but Goldman Sachs, just as one of the best run U.S. banks, they've cleaned a lot of stuff up, and the last quarter was their record trading quarter. And sort of going into this quarter, with the volatility in the markets, I think there's upside to the sort of what's priced in on their earnings now. And then again, on the pipeline of IPOs, SpaceX being one, but there's a significant amount of companies that are out there waiting to go public this year, that have been waiting. And, with the Trump administration being a lot more friendly to M&A than the Biden administration, you're seeing a lot of that sort of investment banking activity, pick up. And I think even in the more volatility will come out, more deals and will happen, and that'll just be a big, boost for the larger banks that are involved in those sort of deals.
One of the sites. All right, Mike. One of the key messages that we want to deliver is that we've been extremely active throughout this period of time, and we're upgrading the quality of companies that we're buying with every opportunity that we can. And so we're doing a significant amount of research and taking advantage of tools and resources that we have available to ensure that we're improving on our portfolio to better the returns. And so it's one of the things that we take an active approach with, and will continue to do so. So sorry, Mike, I cut you off.
And all I want to say in these times like this, similar to last April, I want to emphasize high quality companies with strong cash flow and pricing power. At the end of the day, we don't want to be looking at things that are not making money, that are highly speculative. The ones that will rebound rather quickly are companies of that nature, and you want to stick with quality. They will rebound rather quickly. The other areas are usually something at a later phase in the cycle, and I would not be a strong buyer of smaller type companies that are not in that position of cash flow or purchasing power. So again, Ryan, to talk to you about some of the companies we own, but they're all high quality, very profitable, and leaders in the industry. Not only in North America, a lot of these companies do work all over the world, so they're globally as well. So that's our emphasis. And as Diego had mentioned, we are buyers, not sellers of this marketplace. Now, we are upgrading some of the companies that we want. If we see opportunities, we will trim or exit a position to find an opportunity that has a little bit more upside in the portfolio.
Yeah, absolutely. I think I'll echo, both points. Is that, something we've talked about is that this is a market for being active. There's a lot of, there's a lot of different winners and losers. This isn't a market where, everything goes up in a straight line. Quality, especially in volatile times, like I said, will be your best friend. You want the best of the best. yeah, if we do make some sales, it's only because we feel like we can buy something even better and continue to improve our portfolio. We're buyers of this market. We want to be in this market. Um, we believe there will be a quick resolution, and the probabilities show us on a 12-month basis the market's going to be positive. We don't know if this is the absolute bottom, but we're going to continue to buy the best businesses, the highest quality companies, and from the whole portfolio perspective, try and take advantage of this, but also try and protect capital as best we can as well. So I think overall the message.
Yeah.
Oh, sorry, go ahead.
So I want to say a couple things. One is, last year in April, I mentioned to everybody, be patient. I mean, we'll be the beneficiaries of this. It doesn't happen overnight. And so be patient. Give us over the next 30, 60, 90 days. I think we'll see resolution to all this stuff, and you'll start seeing the decisions we made will be big winners. I also want to say that, while volatility has increased, underlying economic and corporate fundamentals remain intact. And really haven't talked much about that. But I mean, if you look at the statement from Goldman Sachs, they could reconfirm their guidance for the end of the year. The environment is still very strong. The economy is still very strong. We just got to be very selective in what we're buying. You got to be active in this type of market, and you got to make sure that you're picking some of the best companies in the world. So a flight to quality is really key. So. But patience is required. You will be the beneficiary of the decisions we make by year end, if not much sooner. Go ahead.
Yeah, our plan is to continue on with these videos, providing updates specifically as it relates to what's going on right now. Our hope is that we can get some feedback and questions from the general audience to ensure that we're touching on some of the things that you want us to cover off. And our hope is that you find value in these videos, and would really appreciate any feedback, both positive and negative, on what you'd like to see, and how we can better provide communication to you as the clients. And we appreciate your support. I know it's trying, but we're certainly working very hard on trying to improve our portfolios and move it in the right direction.
Well, thank you. I think, Ryan, correct me if I'm wrong, we may do another one at the end of the week if it's required. If not, it'll be another one possibly next week after the Easter holidays. If we do not do another one, I wish everybody a happy Easter. And by all means, reach out to any one of us if you have any questions or concerns about the markets or what's going on. Thank you for your trust and your confidence.
Thanks.
Thank you.